Welcome to vTalkInsight, Market Drivers Daily for March 11th, 2026. Oil shocks, AI enthusiasm, and fragile supply chains are colliding today, forcing rapid repricing across rates, equities, and credit. We will look at how the Middle East energy shock, the latest AI earnings from Oracle, and deepening commodity bottlenecks are shaping the macro backdrop and cross-asset risk, so that short-term price action can be set against a broader regime shift. Energy remains the central macro driver, with the conflict around Iran and an effective shutdown of the Strait of Hormuz, creating a genuine supply shock rather than just a risk premium. Current disruptions are removing well over 10 million barrels per day from global supply. Once lost production and blocked transit are combined, while alternative routes are limited. Even record-sized strategic reserve draws struggle to match that scale in the near term. Policymakers are responding with unprecedented measures. The International Energy Agency has lined up a 300 to 400 million barrel release from emergency stocks, and countries such as Japan are preparing unilateral draws to cushion domestic fuel costs. However, the effectiveness of that headline volume is constrained by flow rates and logistics. It could take up to 200 days to deliver the barrels and roughly 2 weeks before extra crude reaches refiners. So the gap between lost seaborne flows and replacement barrels remains wide. Compared with a few days ago, crude has pulled back from peak levels above $100, but Brent is still trading above 90 and December contracts sit 17 to 18% over the one-year average. That points to expectations of prolonged tightness. At the consumer level, U.S. gasoline has already climbed from just under $3 to around $3.58, and each $10 move in crude tends to add about 25 cents at the pump. A sustained 20% rise in gasoline alone could lift headline inflation by roughly 1 percentage point. The inflation impulse is colliding with a fragile growth outlook. Persistent oil in the $75 to $100 range is estimated to push year-end headline consumer inflation toward 3 to 3.5%, squeezing real incomes, especially for lower and middle-income households. That threatens the hope for rebound in discretionary spending and is already visible in energy-sensitive sectors. Airlines face rising surcharges and margin pressure, with estimates that a 10% increase in jet fuel could shave up to 20% off earnings per share for major carriers, and even more for the weakest balance sheets. Markets are starting to trade this as a stagflationary shock. Equity futures in the U.S. and Europe are under pressure, bond yields are pushing higher, and expectations for near-term rate cuts have been pared back, particularly in Europe and the UK. The euro and sterling are seen as vulnerable to sustained high crude, while currencies of energy exporters, such as the U.S. and Norway, may prove more resilient. In credit, spreads remain tight and flows into high-grade debt suggest some investors are looking past the shock, but others highlight opportunities in duration and quality if Middle East tensions ease. There's still a strong counterview in markets. Oil futures further out the curve imply a return towards $70 by year-end, signaling confidence that the Strait of Hormuz eventually reopens and that reserve releases will bridge the gap. Supporters of this scenario also point to the U.S. now being a major producer and to potential disinflation from technology and AI-driven productivity, gains that could offset some of the commodity shock. The critical watch points are tanker and insurance conditions around Hormuz, evidence of demand destruction in energy-intensive sectors, and how far central banks are willing to tolerate higher headline inflation before changing course. With that backdrop, the second major storyline today is how AI-linked earnings are trading against this more hostile macro environment. Despite the energy shock, AI remains one of the few areas where growth narratives are strengthening rather than fading. The latest numbers from large software and cloud providers underline robust demand for AI infrastructure and services, but also highlight growing scrutiny of funding models and valuation risk. Markets are trying to distinguish between companies that can turn heavy capital spending into durable cash flows and those that may be overextending balance sheets into a higher rate environment. Oracle is at the center of today's discussion. The company reported revenue growth in the low 20s, with cloud sales up in the mid-40s and infrastructure revenue soaring more than 80%, powered by AI workloads from clients such as OpenAI and Meta. Management lifted its full-year revenue outlook to around $90 billion, reaffirmed a $50 billion AI investment plan, and signaled confidence in achieving around 30% growth into fiscal 2027. The stock has jumped by more than 10% as very negative positioning met better than feared execution. Outside of big tech, concrete AI adoption stories are emerging. One regional U.S. bank now has roughly 60% of employees using AI tools daily, with about a third of last year's code and the vast majority of unit tests generated or automated by AI. That points to meaningful productivity gains, faster product development, and potential margin support even as tariffs, wage pressures, and higher energy costs bear down on operating lines. Similar dynamics are reported across enterprise software, where demand for workflow and procurement tools is accelerating as firms chase efficiencies. Yet the market is far from complacent about the AI complex. Public software valuations have compressed to roughly 16 times forward earnings, now below the broader market multiple, reflecting uncertainty over which business models will ultimately win. J.P. Morgan's move to mark down private credit loans to software companies and tighten lending to funds in that niche underscores rising concern about AI-related disruption and collateral values. Even for Oracle, investors are questioning how easily large data center builds can be self-funded given recent cash burn and the prospect of additional financing or cost savings. On the other hand, private software firms with strong data moats and cloud-native architectures appear to face fewer financing constraints, as supportive investors back rapid AI-driven growth despite public market volatility. Emerging market hardware names tied into the AI supply chain, especially in memory and semiconductors, are also gaining pricing power. Over a longer horizon, AI-induced productivity gains could act as a disinflationary force, partially offsetting the inflationary impact of commodity shocks and resource stockpiling. In the near term, however, higher funding costs, concentration risks around key customers, and intense competition, including for Meta's in-house AI chips, keep this as stock pickers rather than a blanket beta trade. These same forces of digitalization and risk management are now feeding directly into how companies rewire their physical supply chains. Beyond the headline move in oil, the world is facing a broader and more persistent supply chain shock. Disruptions now stretch across crude, gas, fertilizers, metals, and petrochemicals, and are interacting with earlier distortions from the Russia-Ukraine war and ongoing trade tensions. Even a rapid ceasefire would not instantly normalize flows, because the bottlenecks are as much about logistics, insurance, and financing as they are about physical production. The Strait of Hormuz has effectively become a choke point for the entire system. Attacks on vessels, mine-laying threats, and confused messaging around naval escorts have sharply reduced tanker traffic, pushing insurers to withdraw cover and driving up freight costs. Estimates suggest that restarting over 6 million barrels per day of offline regional output would take around 4 weeks, and that even with maximum emergency releases, more than 10 million barrels per day of effective supply are currently missing from the market. These frictions extend well beyond crude. Liquefied natural gas shipments, refined products, and fertilizer exports are all affected, with some agricultural chemical producers seeing outsized share price gains as nitrogen and phosphate prices rise. Global supply chains for metals and petrochemicals are also under strain, partly because sanctions have turned some central bank reserve from shock absorbers into shock amplifiers, changing how commodity exporters recycle surpluses. Even large strategic oil releases are being absorbed quickly, with prior episodes showing prices moving higher again within a week. Corporates are responding by rethinking both physical and digital infrastructure. Tariffs and tighter immigration rules are adding to labor and input costs, So businesses are investing more in procurement, logistics, and workflow software to squeeze out efficiencies. Enterprise platforms that help redesign supply chains, manage inventories, and automate processes are seeing stronger demand, while countries such as China are leaning on prior stockpiling and strategic focus on technology, batteries, and green energy to weather the storm. Over time, this points to more onshoring, friendshoring, and a larger role for data-rich supply chain managers. The counter-argument is that as reserve releases ramp up and shipping gradually reroutes, some of today's bottlenecks could ease faster than feared, especially if demand slows in response to higher prices. The U.S., as a major producer, and non-OPEC supply growth offer additional buffers. Even so, many assessments suggest recovery will still take months, not weeks, keeping cost pressures elevated across commodities. Key signals to track are the pace at which tanker and insurance markets normalize, the degree of demand destruction in energy-intensive industries, and how aggressively firms continue to invest in supply chain resilience. Together with the energy and AI dynamics we discussed earlier, these will frame the next phase of cross-asset pricing. To wrap up, the energy shock from the Middle East remains the dominant macro force, pushing inflation expectations and rate paths higher, even as strategic reserve releases attempt to smooth near-term supply gaps. AI-driven growth stories, led today by Oracle's earnings, continue to attract capital but now sit under closer scrutiny around funding, margins, and credit risk. At the same time, deep and persistent supply chain disruptions across commodities and logistics are reinforcing the shift toward an asset-heavy, resilience-focused regime. Watching tanker traffic, upcoming inflation data, central bank messaging, and corporate guidance on energy costs and AI spending will be critical for framing risk and scenario ranges over the next few weeks. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.